Hello and welcome. You're watching ET Markets. I'm Tanya Aneja. Well, mutual funds have always been a preferred choice for a lot of investors, but it is very important to choose the right schemes so that you can get the expected returns. Today, I'm going to be joined by a very special guest who will tell us about the best mutual funds, ideal portfolio allocation strategy, and much more. We have with us Mr. Dinesh Rohira, founder and CEO of Finance.com. Thank you so much, Mr. Rohira, for joining us on ET Markets.
Thanks, Tanya. Thanks for inviting me. It's a pleasure.
So let's start with the factors first. I mean, what are the factors one should keep in mind while choosing a fund?
So in essence, the first important factor that you have to look at is your time horizon for the investment. If you're looking for short-term horizons, maybe a year or year and a half types, then it should be not invested on the equity side. It should be invested on the debt side. But if your horizon is medium term, let's say a 3-year upwards of time frame, then you should look at investments on the equity mutual fund schemes. So basically, it's your risk and time horizon that you have to look at, your risk appetite as well as the time horizon. So that's the first factor that you need to consider. If you are risk averse, then while your time horizon may be medium, but you need to look at more safer mutual fund schemes, more safer bets. It could be hybrid or large caps. But if you are a moderate risk appetite and your time horizon is 3 years upwards, then you should look at other schemes as well. So that's the first important element that you have to look at. Then you have to look at what is the objective of the fund that you are currently evaluating to invest in. It should match with your thought and goals in terms of what the horizon and objective of that particular mutual fund scheme is and what your general outlook towards those sectors and segments are, right? And once there's a match between the two, it makes more sense because you're more aligned with their objectives and drives with which that they make those investments on. Then one has to look at the performance in the past few years of what the fund has been consistently performing. There may be fund schemes which might have given spurious returns. There may be surge returns in the past, but they may not have been giving consistent returns, so to say. But what is more important is for you to look at a consistent CAGR return. And the more level of consistency, the better is it for you to have a look at those funds, even if the high-end returns on those fund schemes may not be in line with your expectations. But consistency is the first factor that I would suggest. You've got to look at the size of the AUM that the fund is managing, because unless and until it's adequate size, the robustness as well as the stability of the fund becomes a little more of a question. So look at a fund with the appropriate AUM size, upwards of at least 5 to 10,000 odd crores on the equity fund scheme. And when you look at the most important, the last but not the most, but one of the most important factors is the fund manager, the quality of the fund manager who's managing that fund, their credibility and their track record in terms of experience and the delivery. That's important to look at. These 5 factors, once you look at in terms of your risk and time, objective of the fund, consistency of performance, AUM size, and the fund manager's performance and track record, that should suffice in terms of the factors to consider.
Okay, absolutely. And as you rightly pointed out, it is a fact that one should choose mutual fund schemes based on the risk appetite. So there are investors with a moderate risk appetite and some are willing to take more risk. And in fact, many young investors are now looking at mutual funds with a trading mindset. So what kind of funds would you advise on the basis of risk appetite?
So in terms of the risk appetite, I think if you are a risk averse, so it depends upon the time frame in the first place, right? If your time horizon is 1.5 years, anywhere in that or less than that, then you should look at debt funds largely. And if your time horizon is upwards of 3 years or equal to 3 years, then I would look at the risk appetite and then advise. If you are a high risk taking personality and you are a millennial, that's typically where the millennials would fall, then you could look at close to 50% of allocation to small cap funds, 20 to 30% to mid cap and multi cap or a flexi cap funds, and about 20% to large cap. If you're a moderate risk appetite, then I would suggest about 30% to 35% on large cap, 30% to mid cap and flexi cap funds, and the balance about 25-30% into small cap funds. And if you're risk averse and you would like to stay a little conservative on your investment approach, then I would suggest at least 40 to 50% in large cap, about 30% in mid cap and flexi cap. And within large cap also, if you want, you could have a 10 to 20% allocation to hybrid funds, and about 20% into small cap.
Okay, absolutely. And also, do you think large cap schemes fare better in a volatile market? I mean, many investors and mutual fund experts now believe that large cap schemes are now losing their mojo lately. So what are your thoughts?
Yeah. Not really. I think they bring in. They're not losing their mojo, so to say. They bring in the level of stability, and there's downside protection. I would not say protection, but there's a limited downside that you would see compared to the other fund scheme categories. And while it's a little boring kind of a category, so to say, large cap, they have a limited upside, they have a limited downside. And hence it becomes a little boring. And since majority of the new age investors are millennials, the large amount of addition to the mutual fund investor base, the recent ones have been millennials, large cap may not appeal to them as much because the risk appetite is much higher. But to look at it from a category standpoint, large cap does deliver a significant amount of robustness and stability to your investment. It limits the downside, and if you're looking at anywhere between 13 to 15% CAGR return over 3+ year or a medium-term cycle, then large cap augurs very well.
Okay, absolutely. And what about your top recommendations? I mean, top mutual funds, if someone is planning to invest in 2022?
Yeah, if you're looking at in the large caps space, or are you looking overall?
Overall, I would say.
Yeah, so I would say you would look at some amount of large cap funds. So I would recommend a Nippon Large Cap Fund, ICICI Blue Chip, HDFC Top 100 among the large cap categories. Then you can look at a Kotak Flexi Cap Fund. Okay. You could look at Mirai Asset, equities fund. These are some of the fund schemes between the large cap and flexi cap that I would advise. Small cap is dependent on your risk profile, and I would recommend that you look at an advisor who would recommend the appropriate small cap for you at the given point in time. HDFC small cap is a decent fund that I would look at.
Okay. And also, as an investor, I mean, it is important to build the portfolio with proper asset distribution, I mean, to create long-term wealth. So if someone is planning to invest in FY23, what should be the ideal portfolio allocation strategy according to you?
So if someone is looking at FY23, then looking at the current market down cycles that we have seen right now, from here on, I would look at FY23 would be 23-24 would be a good year from the market standpoint, and being a depressed market conditions currently, and which is coming out of that for now, but we need to see a couple of more months down the line. I would recommend that over the next 1.5 year time frame, you should look at a 50% allocation to small cap,
okay,
a 30% to mid and flexi cap, and the balance 20% should be into large cap, or you could put into hybrid funds as well, because there's adequate amount of risk exposure between small cap and mid cap funds that I'm talking about.
Okay, absolutely. And also, Mr. Rohira, the Reserve Bank of India is likely to hike its key interest rate on coming Friday. So what does it mean for the mutual fund investments?
Yeah, so I guess I'm not sure what's the hike that you can expect, but the normal word in the market is about anywhere between 30 to 50 basis points, right? And if it's somewhere in that range, then I don't expect any negative impact on the equity fund schemes. Okay. The market will take up in its stride, and it's all built into the current market conditions. Anything more than that, yes, it can have a temporary effect for a couple of days or weeks, but I guess that is an unlikely scenario. On debt funds, on duration funds, there would be an impact. Specifically in the short-term duration funds. sorry, not the short term. The short-term duration funds would be isolated from the hike, but the long-term duration funds would be impacted. So anybody having investments in long-term duration funds should watch out. Short-term duration funds should be fairly taking that into the stride, as well as equity fund schemes. They should not get affected.
Okay, absolutely. And lastly, before we let you go, any top financial planning strategies for young generation? I mean, to save and invest money wisely.
Yeah, so I think normally the basic behavioral pattern is you earn, you spend, and then you save. My advice specifically for millennials would be you earn, you invest, and invest or save, and then you spend. And while I'm not promoting savings of large orders at early stage, but you would be better off by investing in small amounts, smaller savings that you would look at. So something like, let's say, 100 rupee a day. That also could be a fairly decent savings exercise or a habit to inculcate at an early stage environment. Just to share, 100 rupees a day, which is about 36,500 a year, adequately invested in the right asset allocation over a medium term would deliver about anywhere close to 75 lakhs to a crore kind of a corpus for that 36,500 invested over a 30-year horizon. So the power of compounding would kick in. So 100 rupees a day, we are fairly comfortable. Somebody may be spending that kind of money in drinking teas 5 times in a day, or smoking, or traveling via cab or auto and all this stuff. These are expenses which one can control on. These kind of investments or savings can be done, and you could see a significant compounding effect later on during your life cycle.
Absolutely. That's the advice coming in. And on that wonderful note, thank you so much, Mr. Rohira, for joining us here and taking the time out for us. Thank you so much.